Good afternoon, everyone. My name is Chris Ennis. I'm the founder and chief investment officer of Dream America, a single-family rent-to-own company based here in Miami. We're currently operating in major metro areas of Florida, Georgia, and Texas. I want to start out by thanking Michael and Flya for giving us the opportunity to speak here today about our program. We've got some slides we're going to go through in terms of how Dream America works, what we're trying to achieve. Feel free to jump in with questions. We can stop as we go and try to answer those on the spot. Just in terms of background, as I said, I'm Chris Ennis. I spent 25 years on Wall Street, mostly in the derivatives space, Salomon Brothers, Bank of America, and BNP Paribas. And you may wonder how all of that leads to anything in real estate. I've been an investor and developer of residential and commercial real estate since 2000. When you're in the securities business, real estate is one of the few things that compliance lets you do without hassling you. And I left banking in 2017 and started working on this project full time. What attracted me to the opportunity in single family lease to own were a few factors. I'm not going to go back through the macro housing backdrop, which the last two speakers have done a great job setting the stage for you in terms of supply shortages, what's going on with prices, what's going on with rents. All of those same dynamics are obviously at play with Dream America. What I thought was interesting when I first looked at lease to own is it's a relatively uncrowded space. Most areas of consumer finance, you'll find hundreds, if not thousands, of competitors. When you look at lease to own, though, you're really sitting in this middle world between asset owner and lender. What our program is, we'll get into the detail. You can think of as a type of bridge funding for our clients to help them on the path to home ownership, but we own the assets. So it's not something that lenders are going to want to get into. And the people landlords who just focus on owning the assets generally aren't going to want to sell those assets to their tenants. They're going to want to just own more and more of them. And we've seen many large single family rental companies spring up since the financial crisis that are doing just that. So this was an area that we felt like there's not a lot of people in. We'll talk as we go through this about who a couple of the competitors that are out there and a few have popped up, but it still remains to this day a very uncrowded space. So if you want to go to the first slide here. So the backdrop is we looked at what is nationwide demand. And we really think of our program as a feeder into an FHA or VA mortgage. For those of you who are not familiar with those products, they're great mortgage products that are only made possible by guarantee from the federal government. So FHA is open to everyone. It's a 3.5% down payment, and it makes homeownership accessible to a whole group of Americans who would never get there if they had to get to a 20% down payment. Similarly, VA is also backed by the government. That's a program for veterans and requires no down payment for a veteran to be able to buy a house. These are great products, but as they are backed and insured by the federal government, the minimum lending standards for those products are set by the government. What's the significance of that? It means that if you're a lender offering these products, you can add extra requirements, so-called overlays, but the minimum you can't waive. Whereas if someone on this call, let's say you went to your private bank, First Republic, Citi, whoever you dealt with, and there was something in your file they didn't like, the loan officer could always escalate that to the head of underwriting. And if they wanted to, they could waive it. That's just not possible with FHA and VA. So you have this large group of people that would like to buy a home. They're a candidate for one of these mortgages, but they sit just outside the perimeter of being able to qualify. And so we analyzed, this was a couple of years ago, but it's still true today, FHA and VA loan volume and turndowns in major metro areas nationwide, and looked at the reason for the turndown. Was it that the borrower's FICO score was too low, which could make them a candidate for our program? Or was it that the borrower had no cash, which would not make them a candidate for our program? We'll get into our requirements for a minute. And based upon that, we estimated that the nationwide demand is 35 million households. So this is not a question of, are there 2 competitors, 5 competitors, or many, many more? Given the amount of capital it would take to really serve this market, we can really almost consider the opportunity to be limitless in terms of potential demand for our product. So how exactly does it work? What are we looking for? We accept applicants that have the income to put them on a path towards mortgage readiness over the course of a 12-month lease. That means that we're looking at their pay stubs, their tax returns, their bank statements, the same thing that a mortgage lender is going to look at and see, okay, if they're not able to get a mortgage today, do we see a path that would allow them to get one over the course of the next year? That is the cornerstone of our approval basis. If the answer to that is yes, then we will assign them a budget. So we'll say, hey, you're good for a $250,000 house. They'll now go out into one of the communities that we're active in, like Atlanta, with their realtor and pick any home that's listed for sale. We'll then buy that house and rent it back to them until they're ready to buy. And like I said, it's a 1-year lease with an option to buy. We'll get into the economics of that in a minute, but they can cancel the lease at any time when they do purchase. So they're not even locked in for a full year. If they get their act together and they're able to buy in 6 months, great, we let them do it. On the flip side, if they're still not ready after a year, but they have been making their rent payments on time, they can renew again for a second year or even a third year. And we've had a number of people that have needed to do that. So there is that flexibility in the program. I want to flip to the next slide on the requirements. So what are the minimums that somebody needs to apply? And this information is all posted on our website at dreamamerica.com. We pride ourselves in being totally transparent with folks. No one's ever going to go into one of our houses and then say, gee, I really didn't understand how this worked. They might, but that would mean that they've ignored everything that we've posted online. All the details are there. So we're looking for minimum household income of $4,000 a month, minimum FICO score of 500, at least $5,000 of cash available from savings, 401k or gift, and a 12-month record of on-time rent payments. Now, how many people that are at those minimums actually get approved? Well, very few. So if you look at the profile of who is actually getting approved in today's market and getting into a home with us, our typical applicant that is successful has household income of $6,000 to $8,000 a month. So they're really in the same range as median household income. They're going to have more likely than not closer to $10,000 of savings as opposed to our stated minimum. And their FICO scores probably in the mid 500s, although it may even be into the mid 600s. So that's what the demographic looks like. Then once we've given them this approval, as I said, they go out with their realtor, they pick the home. Dream America then gets it under contract. So for the client, this feels like a traditional home buying experience. It wasn't, hey, we've got these houses, and if you want to, you can rent one and maybe one day buy it. And they go, well, that really wasn't the house I wanted or the neighborhood I wanted. No, they're going out and they're picking that house just as a home buyer would. But then once they've done that, we get that house under contract and we do a quick inspection. So it's 7 days or less, and we close in 2 weeks. And most importantly, in this market, we're coming in as a cash buyer with no financing contingency. Now, we do use financing on the backside, but there's not, from the seller standpoint, there's no mortgage contingency. And we're giving them proof of funds showing, hey, we've got the cash in the bank to close on this home. And that really puts us on par from a seller standpoint with much bigger institutions. So they're sitting there, and as previous speakers were mentioning to you, really hard to buy a house in today's market because you have all these cash buyers. Some of those cash buyers are individuals, but more likely than not, it's these large rental companies. So you're the seller and you've got 5 cash offers. Well, the people who are coming in with a mortgage contingency, they're in a really tough spot in this market. They're probably out of luck. But now you've got these cash offers. How do you pick which one? Well, one thing you're going to look at is what's the inspection period. I said we do it in 7 days. Most of the big institutions are 7 to 10 business days. They're not going to look at an inspection report on the weekend. We do. A lot of real estate gets done on the weekends. 2-week close, no one's going to beat that. That is about as fast as anyone's going to close. But now, if the realtor is able to articulate who is Dream America to the seller, that may be the tipping point. Believe it or not, if the seller is an individual who's lived in the home, yes, they want to get the best offer, but at some level, they may also care who's buying the house. And we've seen a lot of sellers push back on the fact that their neighborhood or their former neighborhood are being all turned into rentals. And when they realize, oh, here's Dream America LLC, what's that? Another rental company? Oh, no, they're actually helping the Jones family who's going to be moving in to that house. They're helping them buy that house, but there's still a cash offer. They still close fast. They still have a quick inspection. And so we've actually had great success, even in this very competitive market. We're closing on homes every week. We have a very high acceptance rate on our offers. And this is really a hidden benefit that our clients didn't even necessarily think about when they came in, because had they not needed us and gotten that mortgage approval on their own and went out, they would probably find it impossible to get their offer accepted right now. So that's just another benefit that people are getting out of it. You can hop on to the next slide. So what are some of the benefits from the investor side? We talked about, why this could be an advantage for the individuals, for our clients. From an investor standpoint, we have an asset that is generating a high yield, and we're going to go into those economics in a minute, with a relatively short duration. On average, the 60 homes that we have sold since inception, and 80% of those sales have been to our tenants, we've held on average for 415 days. So an investor coming in is not needing to wait for something that's going to play out over a 5 or 10 year time horizon. We're turning these properties over relatively quickly. As opposed to a lender, if we were just lending to this same client group, we are the owner of the asset. And although we never like to do an eviction, and I'm happy to say I can count on one hand the number of people we've had to evict, if we find ourselves in a situation where somebody is not paying, they're not performing, the process for an eviction is much more straightforward than a foreclosure. So that is something that we're able to do quickly. And again, that's a benefit that ultimately accrues to the investor. If someone's not paying their rent, they're able to reclaim that home. Our clients have skin in the game, and this has numerous benefits to it. What does that mean? That $5,000 cash that I said we're looking for, we're collecting a 1% fee up front from our clients. So $250,000 house, we're going to get a $2,500 fee from them. And we're also collecting a deposit from them, an earnest money deposit, that's at least 1% of the home price. In some cases, it may be 3 or 5 or even 10%. It really depends on the individual profile. That's ultimately going towards their home purchase. And so they're coming into this, although legally they're a renter, we own the house. If you talk to our clients, they would not describe themselves as renters. What they would say is, no, this is my house and Dream America is helping me buy it. So they're coming in with an ownership mentality, which pays dividends constantly for our investors. It means they're more likely to pay their rent on time, because paying your rent late is a great way to get denied for a mortgage. Most lenders are going to ask for, just like we verify their rent history on the way in, most lenders are going to do the exact same thing when they go for a mortgage. Maintenance. We spend little to nothing on most houses in terms of maintenance. Our clients are responsible for routine maintenance items during the life of their lease. This is a huge differentiator versus a typical rental company that is investing a lot of money in maintaining the house. I'm sure you've heard the old saying from Warren Buffett, nobody washes a rented car. And the same mentality can apply in the home sector. If someone's just renting a home, that's the landlord's problem. If this is going to be my house, this is my problem. So to make that as fair and equitable for the clients as well as our investors as possible, we're getting all the homes professionally inspected on the front end. We're giving that inspection to our clients, just as a homeowner would have, so they know exactly what they're getting into. We're, to the extent that we need to, we're getting credit from the seller on the front end to address major items that may need to be repaired. For example, the roof. The house needs a new roof. We're not going to just throw somebody in there and say, hey, it's your house, good luck, take care of the roof. We're going to address those major items on the front end. And then we make sure that every home comes with a home warranty from an independent company like American Home Shield or Old Republic. And for those of you who aren't familiar with it, the home warranty is something that covers routine maintenance items like a leak under the sink, or the HVAC's not working, or the refrigerator. It's very common across the US that when a house is being sold, that there's a warranty frequently paid for by the seller. And it really gives the new homeowner a way to tackle these issues. So it's not just, oh, the lights don't work, now I got to go online and start looking for an electrician, and what's that going to cost me? No, I call the home warranty company. There's a fixed $75 service fee, and the warranty is going to cover the balance of the labor and the parts for that repair. And they're going to send someone out. So I don't have to go and look for someone on my own. I don't have to have a big out-of-pocket expense. This is something that when we started in 2018, it was an idea. We didn't know if it would work. It's worked fabulously well. For most of our clients, our typical deal, they move into a house today. We start collecting rent tomorrow, and we don't hear from them until they're ready to get a mortgage. The rent's on auto pay. They're not calling us on maintenance items. It's a very light touch approach. If there are major issues, of course, we have hazard insurance on all the homes, and we are going to get involved in those. But we've largely been able to stay out of the day-to-day fray on the maintenance side. We've been able to avoid having vacancy, leasing, and rehab costs that you would typically face as an owner of rentals. You want to flip to the next page there? Yeah. So what are these components of our return? Rent. We charge a premium rent. It's just under a 9% net yield, so net of property taxes and insurance. Again, you can go to our website, dreamamerica.com. There's a rental calculator on there. You put in house price, property tax, HOA, if any, and you'll see the rent. Totally transparent. We charge the same rent in all neighborhoods. That means if you get a $300,000 house with us in Dallas, Atlanta, Jacksonville, Tampa, the rent is identical. The only difference is for differences in property taxes that exist in those different areas. You've got higher property tax, for example, in Dallas than you do in Atlanta. The next thing is that 1% fee I mentioned. We're collecting that up front, and we collect that at the time we go under contract on the home that the individuals have selected. And the last is our gain on sale when we sell the home back to the tenant. We're not selling it to them at the same price we acquired it for. We have a standardized markup. It's 6% for 6 months. It's 10% for a year. In the market that we're in now, you can just kind of sit back and do that with your eyes closed because the market's been moving faster than that. But how did that work when we started in 2018 and 19 and home prices were not appreciating at that kind of an annual rate? Well, the key to our sale price isn't just what's the home worth when we sell it. It's also what did we pay relative to the value on the front end. So in a normal market, whenever we return to that, which is what we had in, let's say, 18 or 19, we would typically get a 3 to 5% discount to appraised value. More often than not today, we're buying the homes at appraised value. So really that 6 to 10% spread is a combination of what kind of discount can we achieve on the front end, and then what is the home price appreciation been, during the life of the lease towards the back end. If we get into a slower market, let's say that we have, not here to call for a recession, but let's say we get into a recession and home prices appreciation not only slows down, but we, start to go the other way and home prices start to drift down. Well, that would also be a market where you're going to see increased days on market, and every home that's being sold is in a knife fight with 10 offers. And those discounts that we got that were 3 to 5 on the front end, they'll be larger, they'll get bigger. And so again, the key for our program working isn't just the best possible housing market. It's something that we believe will continue to work over time. And the key is where can we get that house in the front end versus the sale on the tenant to the back. Next slide, please. So if you look at those 3 components, here's a illustrated example of a new home being added to the portfolio. When we add up that rent, the fee, and the markup, we're looking at a 1% unlevered return for a year of 14%, which is pretty high for real estate. And when we translate that and say, well, how's that actually played out across the portfolio? We've sold 60 houses. As I mentioned, 80% of the sales have been to tenants, and the average annualized net investor return has been 25% on those sales. So it's worked out quite well. So even once we throw in the cost of running the fund and other costs that we have, and obviously we do use a little bit of leverage as well, we've gotten 25%. Interesting to note, a lot of real estate funds will say, oh, we use a very low amount of leverage. Our leverage has been less than 50%. So you look at our returns in 2019, 2020, and 2021, our loan to value in all those years was less than 50%. And it may creep up over time, But one of the factors that helps keep the leverage down is the turnover in the portfolio. We're always sitting on some cash so that we have money available to buy new homes for our clients. And then we have money that's being recycled as we sell houses back to to our tenants. Next slide, please. We distribute our profits quarterly. So when you invest in Dream America, you're not having to wait years to get a return on your investment. You will get a check the first quarter that you are an investor. And so if you look at what those distributions have been, so that's the rent, fees, and gains on sale that we recognize each quarter, get distributed out to the investors, and you can see what those returns have been over the last few years. There's also additional value that's accruing in the fund that has not yet been monetized. This is just the value that's come from the quarterly distributions to our investors. Next slide. So where do all these clients come from? An important source of leads for us, and the way that we've been able to grow our program, has been raising recognition of Dream America with real estate agents. Real estate agents have a natural incentive to promote Dream America to clients. Why is that? You go to a real estate agent, they say, hey, talk to my lending partner. Lender says, sorry, I can't get him a mortgage for 6 months. Well, now that prospect is just a rental lead. And if you ask any realtor, they'll tell you, we don't want rental leads. They're not worth any money. Same amount of work, but I don't get paid as much commission. I want to represent the buyers, or if I'm really lucky, I want to represent sellers and have the listings, but I want to be involved in those purchase commissions where I may earn up to 3%. Realtors quickly realize this and wind up promoting Dream America to their clients. We have some agents that focus on this full time, but for most agents, it's just a piece of their business. So we're constantly looking to raise awareness. And we've done training classes for agents. We have various materials that they get. You go to dreamamerica.com, you can register as an agent, and you'll have access to a wealth of information on how the program works, and just as importantly, how to incorporate it as a realtor into your business. So you can see right now we have over 3,800 agents that have registered with us, and many of them are actively promoting it. Next slide. And so that's led to a big growth in our application base. It looks like we were sitting around and not even doing anything in 2018 and 2019 because there were so few applications relative to what we've seen the past couple of years. And coming back to the statement that I made at the beginning in terms of the nationwide demand for this, it wasn't that in 18 or 19 the demand wasn't there. It was just people didn't even know we existed. If you don't know that this is an alternative, then how would you go Google it? You're not going to go Google Dream America if you don't know about it. Now, you might go and Google lease to own, and we will show up in certain markets for that, but that is the space that, because it's a popular topic, there are many companies who use the term lease to own as a way to drive traffic to their website, even though they may not be doing anything like us, just a way to grab leads. So we've had a nice surge in our application base, and the way that we've been able to keep up with this, because we're a small team, there's only 4 of us, so we certainly don't have time to go through 1,000+ applications by hand each month, is we've developed an automated underwriting system for pre-approvals. So when you go to our website and you apply, and this is something that we rolled out late in 2019. So as we made a push to get more applications in, we had a way to deal with that increased volume. You fill out an application on our website, you put in your income, you put in your payment information, you are given the option to link your bank account using Plaid, so we can immediately verify your bank balance. If you don't want to do that, you can submit your bank statements later. But based upon your income and your payments, the system is immediately going to give you a pre-qualification amount. So you'll know right away, hey, you may be qualified for a $300,000 home, but to get fully approved, we're going to need your supporting documents. All of that is automated. Or, I'm sorry, we can't approve you at this time because of your income's below the minimum, your cash is below the minimum, you had a recent bankruptcy or foreclosure, you're not a US citizen or permanent resident. All of these requirements are baked into the system, And we found this is really important in terms of client acceptance, but also realtor acceptance, because if somebody's not a candidate for our program, they may not have other alternatives. Their alternative is probably renting. And so in some sense, knowing quickly, hey, this isn't going to work, is certainly better than being dragged out for weeks and then being told, no, you're not qualified. And on our side, it allows us, like I said, to get through a lot of applications. So only 40% of the people who apply with us are pre-qualified. And then the funnel narrows down that list considerably as we get towards final approval. And the funnel revolves around people submitting their documents. So they have to, they say they make $80,000 a year, we need that pay stub that shows it. If they're self-employed, we need the tax returns that show that income that we can underwrite off of, that a lender will ultimately be able to underwrite off of in the future. Next slide. So I mentioned there are a couple of competitors. Who are they? So the 800-pound gorilla in this space, and the one that I first saw when I started looking at this a number of years ago, is Home Partners. So Home Partners, this was a company started, I think, by Lou Ranieri, initially had a different name, Hyperion Homes. And they really are the ones that I would say brought institutional credibility to the lease-to-own space, which frankly it's something that's been around lease-to-own for a long time, but frankly was an area that did not have a great reputation. Home Partners brought in institutional capital and really kind of exposed a broader audience to it. They were purchased last year by Blackstone. There is no Home Partners fund. There's not an opportunity for you to invest there unless maybe you're close with Blackstone. Maybe there's a way to get some money in, but they're not doing a fund. The other group that's popped up the last few years is Divvy Homes. Divvy Homes is a VC-backed company. They launched maybe a year or so before us, backed by Andreessen Horowitz. And so they've raised a series of rounds of capital. I think their last raise was at a $2 billion valuation. But again, it's not a fund. They're trying to grow very rapidly, probably losing money, like a lot of VC-backed companies. And there's no opportunity to invest with them and get distributions. You may be able to invest in one of their rounds, but if you do, again, you're going to be waiting for a future liquidity event, whereas we're paying our investors as we go those distributions each quarter. Next slide. Here's some of the testimonials for our clients. We have, and every time I say this, I feel like I'm jinxing myself, but if you go and you look on Facebook, you look online, we have a lot of very positive reviews. That is not true with Home Partners and Divvy. How have we been able to maintain positive reviews over a long period of time? We focused on good service to the realtors who really become our repeat clients. We try to make our program the easiest and most accessible for the real estate agents. So they want to recommend that to their client. We've gotten a lot of people into homes and we've helped them become homeowners. But most importantly, what I mentioned before is that many of the people who apply for our program are declined. And for any of you who've ever applied for credit and been declined by a bank, you get an adverse action letter. It's not terribly informative. Basically says you applied with me, you're not approved, here's the reason, which may or may not make sense to you, go away. That's it, end of story. For us, when we decline someone, it's never a permanent no. What we say is, if you can address the following, we invite you to reapply in the future. And so as people go through this process, they may not get approved, but they're getting concrete feedback. And we've had many of those people come back to us in the future and get approved in the future and get into a home and get through the program if they took that feedback seriously. We've had other people that we don't hear from, and then they call us a year later and say, hey, guess what? I got a mortgage and now I'm a homeowner. Thanks so much for that advice that you gave us. And I think this really is generated goodwill for us online, because we're not just telling people, hey, you got no shot, go away and leave us alone. We're leaving the door open to everyone. Next slide. So in terms of, what are the terms of the fund? So Dream America is organized as an open-ended fund. We accept subscriptions monthly. We also offer annual liquidity, charge a 1% management fee and 15% of profits, which is realized at the time the homes are sold. So although we're on GAAP and we're valuing the portfolio on a regular basis, there are no fees that are linked to that valuation. The performance fee is tied to the sale of the homes which is leading to a distribution to the investors. So there's no issue around that. In terms of a couple other things to note on here, most of our investors have come in through the equity investment and LLC interest, but the fund also offers notes that pay 9% interest. Why do we offer in notes? Really, we developed that because we are turning over our inventory and we're using some leverage. As I said, we have some borrowings. You wouldn't want to put the fund into your IRA because it's generating UBIT. So if you said, hey, I'm interested in what Dream America is doing, I'd like to participate, but I want to do that in my self-directed IRA, the notes is going to be a better way for you to do it because that's just generating interest income, which won't have any tax implication for IRA. So that's why we have that available as well. And I think that's it. Beyond this, what do we have? Just my bio and Kemp's bio. So I didn't mention here, my partner worked with me at Bank of America and BNP Paribas, started the company back in 2018. His bio's in here as well. Kemp Schuschler, and then we've got a couple other folks working with us as well. So with that, I will open it up to questions.
All right, so you got a lot of requests for the deck, so I'll get those to you.
Sure.
One person asked, do you have a Cayman vehicle for foreign investors to invest in? They'd also like the deck.
No,
okay,
we don't. The foreign investors can also do the note. So the note is also a way. Many countries have tax treaties with the US. So, and so you'd have to, kind of look at that, but interest income is not. There's all sorts of issues when you get into US real estate for foreign investors because of FIRPTA. So there's not a simple solution for that.
Okay. What are some of the next cities and how do you choose which cities you enter or areas?
Yeah, so in terms of the cities that we're in right now, we really looked at when we were starting all the demographic trends that people were speaking about before, which is where people, and this was all pre-COVID, right? So now the floodgates are open in terms of people working remotely and moving all over the country. But even before that happened, there were movements into the Southeast, people looking for more affordable housing and good education and lower tax rates. Obviously, Texas and Florida don't have state income tax. So there are a lot of things at play there. We want to be in major metro areas, not that there's not demand in rural areas. And for the time being, our growth, our expansion really isn't predicated on finding more cities. So, our biggest market is Atlanta. We've bought over 100 homes in Atlanta. Home Partners has bought over 2,000 houses in Atlanta. We could spend the rest of our life just serving Atlanta, and we're already in Florida and Texas. If we were adding additional markets, because we didn't always have Dallas in there, for example, one of the things that we look at beyond the real estate dynamic, believe it or not, is where are the competitors. So in most businesses, you'd love to go where there are no competitors, but in ours, we actually benefit from going to cities where Home Partners and Divvy are active. Because one, they spend a lot more than us on marketing. So they kind of chum the waters and raise awareness in the realtor and consumer community that lease to own might be an option. Two, they're then much harder to work with than us. So they go out and they get everybody excited. And so we have done zero advertising in Dallas, but we get leads every week. And who are the leads coming from? Realtors who've gotten frustrated with Home Partners and Divvy. And there's another company out there too called Trio. And so they look for an alternative and they find Dream America. We're the only group that has 100% transparency in our program terms. As I mentioned, they're all on our website. We are the most consumer friendly. If you kind of stack up the terms side by side, Divvy's looking for a 3-year lease. That might be good for them. Doesn't really benefit the consumer. We're doing the 1-year lease. Home Partners does a 1-year lease, but only 10% of their clients wind up buying the house. So is that really a home ownership program or it's just a rental program? So I think we've gotten the reputation with the realtors that we're easy to work with. And if they have a client that's serious about becoming a homeowner and is not just, kicking the tires and thinking about it, that Dream America is a good one to recommend. So other cities that we would go to as we expand would include places like Phoenix or Denver. These are key markets for some of these other competitors. But really there is, and we have a slide, it's not in the deck, but I can send it around if you guys want it, where when that work that we did at the beginning, where we kind of mapped out a nationwide opportunity, where we looked at a bunch of major metro areas. So you could really run this, program in any market, and you're going to find that this demand is there. The yearning for renters trying to fight against all of these macro forces that are working against them to cause them to continue to rent, and to get over that hump and become a homeowner. That's everywhere, and it's not going away.
Please discuss tax features passed on, like depreciation, long-term capital gains upon sale. I assume the rent is ordinary income, but can be offset by depreciation.
Yes, so the income it's all passive income. So to the extent that you have, as an individual investor, other passive losses from other real estate or business investments, you can offset it against that. But there is no long-term capital gain. One, because we're turning over the portfolio, and two, Dream America is essentially a dealer, meaning we're not purchasing a home with an intent to own it for 5 years. We're purchasing a home with an intent to sell it to our tenant. So that has different tax treatment under the code. You can almost think of us like a home builder. Home builders, we're not building homes, but from a tax standpoint, that's how it works. We do depreciate the homes. But again, as you're probably aware, when you sell real estate that you've depreciated, the depreciation is recaptured. So that has not been a significant benefit. It's been a small benefit, but it has not been a significant benefit given the turnover in the houses.
What markets are you not interested in going in? Are there any?
Yeah, rural areas. Rural areas. Again, I think about all of these things from a risk-adjusted standpoint, given my background running trading desks. So I'm thinking about not just what's the potential upside, but what's the downside. Right now, you could sell a house anywhere, but in a normal market, you will always be able to sell a starter home in a major metro area. But when you get out into rural areas, those can be much harder to sell. And so we've had, look, every state, we have people coming into us every day asking us to go to their state, their city, but we've really stuck to these to major urban centers. That's where we want to be.
How does the rising price of starter homes affect your strategy?
Yeah, look, it impacts everybody. It impacts our clients. Our stated price range is 150 to 400. I know if you're in a place like Miami or New York, where I spent many years, those are crazy numbers. But when we started, you could get a great house in Atlanta for 150 to 200. 150 is gone, and 200 is very, very difficult. So it's really now those houses that were 150, they're now 250. So that impacts our clients because their incomes have not kept up with that. Home affordability is declining nationwide, a combination of rising home prices and mortgage rates. Our program does not solve that. The one piece that we've taken to try to help with that a bit is, you may have seen, if you go on LinkedIn, you'll see we just announced a partnership in Atlanta to do what we're calling build to rent to own. So build to rent, I'm sure you've all heard about it, super trendy area. Wall Street putting in 40 billion this year, 25% of new construction is going into build to rent, which is another reason why the supply is not getting any better in housing. It's all going to investors. And the timeline, why did we do this? We want to have quality new homes for our clients. Most of our clients, even if they could afford new construction, they can't wait. And right now, in most markets, if you want to get a new home, you're going to wait 4 to 6 months. It's not like it used to be, where you could walk out to a development and look at the model home and these houses are going to be ready in a couple of weeks or a month. And now it's everybody's waiting. And for a renter, they don't usually have that time. Their lease, people who are coming to us are on the clock. Their lease is ending. If they're not able to get approved with us and get into a home, they're going to have to renew that lease. And so they don't have time to wait for new construction. So we started this initiative to try to get some homes into the pipeline that we'll be able to offer to our clients. And those will come in at a lower price point than the average, in the area. Those are priced sub 300,000, which is extremely difficult to find right now, because as some of the other speakers commented on, that's not where the big margin is for the builders. They want to build the higher price homes where they can sell the home buyer the upgrades, the granite countertop and the stainless steel appliances and things that they can get more markup on. The builders' focus on starter homes has been low for a decade plus, and we don't see that changing.
So how many Dream America clients wind up buying their homes? What happens if they do not buy?
Yeah, so out of those 60 homes that we've sold, 80% of those either went to our client or could have gone to them, but they chose a different house. So what does that mean? Why am I including choose a different house in with the success group? I'm including them because their family dynamic changed, the ones I'm thinking of. We have a lot of single mothers in our program. And so by the time they qualified, maybe they're getting remarried and the house that they've been renting from us is not suitable for them anymore, but now they are mortgage qualified and they're able to move into another home. That's not a failure. Everything worked out for the client. They wound up getting a great house. We take that house and reoffer it to another client or we resell it. So I include those on the success side. Then on the 20% that are not following through, some of them are failing. As I mentioned, we've had a couple of evictions, I think 3 or 4. Thankfully it's been very low. But then we've had other people that just decide, I don't like this house, I don't like this neighborhood, I'm leaving. Everybody has a lease with an option to buy, but they're not forced to buy. So they are able to walk away. So when we're underwriting the individual in terms of the likelihood that they can become mortgage ready. We're also underwriting the house, the asset, which is, as an investor, do we want to own this house? Which comes back to why we're not going to let somebody get the house, the rural house, with 5 acres and the farm animals. We don't want that property. So we're going to make sure that if we wind up as the long-term owner of this home, or if we need to resell that home, this is a house that we want to own.
What's the capacity for new investors in the fund?
Yes, no, that's a great question. So, we get a little bit money in, we get a few more clients on, and we've, slowly but surely built up our base. We've got about 81 or 82 homes right now at a cost basis of around 22 million. We are very well positioned to bring in investors who want to put in a couple $100,000, or even a couple of million. We had an individual give us $2 million in Q1. We put that money to work the first month that we had it. For larger, the demand for the product is bigger, but if somebody was coming to us and saying, hey, I want to put 10, 20 million or more of equity to work, we would either need to stagger that if they wanted to come into the fund, or we could set up a separate vehicle for them. This is something that we haven't done, but we have talked to some investors about it who've said, like, when are you going to do, Phoenix? Well, if somebody came to us and said, I want to put in a big chunk of money and I really want to do a market like that, we could set up a vehicle to do that just for them. So our capacity is very large in terms of the market demand, but within the fund, comfortably, I would say we could take in 5 million equity right now. That's kind of our quarterly absorption rate in terms of what we could do.
Okay, Alan wants to know, what do you do to the 20% you don't sell, and the anticipated 6 to 10% profit that does not happen?
Yeah, so for the 20% of homes that are not purchased by tenants, we have a few different options. One, we could offer them to another client, and we've successfully done that a few times. However, a key tenet of our program, which I mentioned earlier, is that we're not just sitting on inventory, we're letting clients pick the home. And that's an important part of their motivation to follow through and buy the house. But we can do that with some, especially in a market like we have right now where inventory is tight. And we say to people, hey, we've got this house, they're more likely to jump on it. So that's one avenue. The other one is we can turn it into a straight rental and then either offer it to another client, offer it to another client in the future when that rental leaves, or we can just turn it into a rental and sell it to another investor that's focused on long-term rentals. We've done that before too. And then the last option is we can just sell a vacant home. So we had a number of homes in Q4 where the tenants didn't buy the house, that the neighborhood changed, they got divorced, different, each one had an individual story. And we turned around and sold those houses. And that's why when, I say we've got a feel for what's going on in the market, we face it as a buyer every day, But in those sales, I see the rental companies, the homes that we sold in Q4, before we even listed the house, as soon as the realtor did a coming soon, we had 4 or 5 cash offers from national rental companies. That is the dynamic that the individual homeowners are up against, which is crushing. We try with our sales to sell to an actual individual, and we're doing that right now with an individual who went through a program called NACA, which helps first-time home buyers. At the same time, we've got a fiduciary responsibility to our investors, and so we have sold a number of homes to rental companies as well. We will do both. So currently, what we're doing, our current strategy today, and it will change over time. If somebody leaves and they don't buy the house, we're going to put somebody else in it, because as home prices continue to appreciate and homes are hard to come by for everyone, just given the lack of inventory, we're not in a rush to sell the house. If our tenant doesn't want it for some reason, we're going to try to keep that and put somebody else in it, even if it's just a traditional renter who didn't come through our normal channel. And then we can start a conversation with them about, do they want to buy the house, which we've done before. We've had rentals where people didn't come through Dream America, they didn't know anything about it, but we just brought in a regular tenant and said, hey, are you interested in becoming a homeowner? 9 out of 10 of them are going to say yes, they do. They're not renting because they don't want to become a homeowner. They think it's not an option. So that's what we're doing with the houses. It's to summarize that maybe a little bit more succinctly, it's not a bad outcome for the investor if the tenant doesn't buy. The best outcome for them, especially given what's happened with home prices, is if they do buy the home. But for our investor, it is still a good outcome, even if from a return standpoint, even if they don't buy.
What's the makeup of these rental companies? Are they smaller mom and pops, or are they large private equity?
These are huge companies. These are companies that own, 10, 20, 50,000 homes. They are large nationwide companies. We bump into the same companies in Georgia and Florida and Texas. This is not the individual who, owns a couple of rental houses as my parents do and have for many years. That's not what we're running into. And occasionally there are real cash buyers, somebody who sold their, home in a higher price market. Hey, I just sold my house in Denver and I've got 400,000 in my pocket. And I go to Atlanta and wow, look what I can get for 400 here. This is so much better. That's not a huge part of the market. Mostly when you hear these headlines about cash buyers, it's investors. It's these large rental companies that are trying to buy all over the houses.
How does the non-sale of 20% affect investor liquidity terms?
It doesn't affect the investors' liquidity terms. So we have the fund offers annual redemption with 90 days notice, and we're selling houses every month. So as people, if we got one of those notices, we just take some of the cash that's coming in through sales to fund that. And if we needed more time, like if we hadn't sold enough, depending upon what, the size of the investment was, if there wasn't enough cash available, then it would just kind of dribble into the next year as we continue to sell houses in the ordinary course of business.
Can you go over the differences between the structured notes and the fund structure?
Yes, so they're both offered pursuant to the same private placement memorandum. They're both discussed in the same operating agreements. These are not two separate offering documents. It's integrated, and it's been there since the beginning. And as I said, we really designed the note for the investor who was concerned about the tax treatment, wanted the interest income or needed that for their IRA, or the potential offshore investor that didn't want to get into the issues of owning U.S. real estate and the FIRPTA rules. So the LLC, as we said, we distribute those profits quarterly, accept subscriptions monthly, annual redemption. The notes are a 2-year note and they pay 9% interest. And again, that's being paid quarterly. So whether you're in the LLC or you're in the note, you're going to get a check from us each quarter. The fund is designed to appeal to somebody who wants that income. We've got a dozen different individual investors who are in the fund. I have a number of people where I have somebody and then they brought their father into the fund. So I have several people's fathers as well who are just, oh boy, this is, even with rates rising, it's still hard to get a decent yield without taking on a lot of risk. And what we're doing is pretty conservative.
Why not set up a UBIT locker for pension money?
Sure, if that's a pension that on the line there that wants to write us a big check, we'll figure it out. My background on Wall Street, I structured a lot of complicated deals, so happy to dig into that. But look, this is, in all seriousness, we started in 2018. We just got our audit from Cohn Resnick for 2021, so we now have 3-year audit. Really, we're just at the beginning of where an institution could start to think about Dream America in terms of having that 3-year audited track record.
Someone wants to know, are you a REIT, or how does this compare to a REIT structure?
No, we're not a REIT, and these are not, again, these are not really REITable assets, if that's a term, because it's inventory available for sale. So if you go and Google that, you'll see that there's a long and complicated tax history around being a dealer or inventory available for sale. That is not something that is eligible in a standard REIT structure. That being said, it's Blackstone's B REIT that bought Home Partners. So clearly, if you've got the right tax lawyers on your payroll, there is a way to figure it out. But at first cut, when we looked at this with our attorneys at Seward and Kissel, these are not assets that fit well within a REIT.
Okay. How do the rising interest rates, you've already covered this, but another question was, how do these rates impact your business?
Yeah, so I mean, look, in the short term, rising interest rates, increase our cost of borrowing a little bit. So just to give you a tangible example, on new purchases, we were getting on a 30-year rental loan, and we don't need 30 years. That's just how the product is offered. We're paying a 5% interest rate up until about February. Currently, that's 6.5%. No surprise. You've seen that 150 basis point move in the marketplace. And those rental loans are securitized product by the lender we're getting them from. So of course, they're locked in once they're issued, but the rate available will change. Over time, if rates continue to rise, we will raise our rents. So I mentioned that our rent is a premium rent. The premium that we focused on is not what is the market rent. We are getting a premium to the market rent, but the real premium that we're interested in is relative to a mortgage. We don't want a client to have a higher payment with a mortgage than they have with Dream America, because that would be a disincentive to buy. We're trying to line up the incentives for them to buy. You've given us an earnest money deposit. You already live in the house. Your monthly payment is going to be lower. There is no reason to not follow through and purchase the home. And so when we set our rental pricing calculator, the one that's on our website, when we rolled that out in 2018, we looked at mortgage rates and we built in a premium that would be a couple $100 a month to a fully loaded mortgage, meaning what a borrower would pay for mortgage, property tax, mortgage insurance, and hazard insurance. So what's that fully loaded housing payment look like? That spread obviously widened because as rates went down, we didn't lower rents, but rates are now starting to get back to 5% mortgage. If you look at the chart, it's back to right around where it was when we started in 2018. So if the 30-year mortgage rates continue to rise, we will have to take another look at our rents because we need to maintain that premium so that people have an incentive to follow through and purchase.
So we got 3 more minutes. You've got several questions that have come in. What I can do is the ones you don't get, I can push to you.
Sure.
One was, who are your lenders? Another was, is income eligible for QBI deduction 199A?
Oh boy, I am not a tax lawyer. Maybe some of my answers gave you that impression, but I don't know what that one is. So you send me a follow-up email. We can try to track that one down.
Okay.
In terms of the lenders, we deal with both bank and non-bank lenders. So we have a 2-year revolving line of credit with a regional bank in Georgia that we've had since inception. And then we've also been using over the past year or so, as I mentioned, these 30-year rental loans. But we're not locked into either lender. We can continue to, to get loans from whoever offers the best terms in the marketplace.
Let's see here. Are there any tax benefits to charge a purchase option rather than rents?
For the individual, no.
Okay.
For our client, no. And that is, I've gotten that question before, where people, oh, rent's not deductible. I said, that is a rich person's question. That is not something our clients think about. They do not think about tax deductibility. That is not why they want to become homeowners. They want to become homeowners because they want a fixed housing payment for as long as they can, as opposed to rent, which is going up every year, and they want to build equity. That is their motivation.
Perfect. You want to give people last minute your contact info, and then we're going to hand it over to Mike to hand it over to GSH.
Yeah, sure. So anyone who wants to can hit me up on my email. It's chris@dreamamerica.com. That's CHRIS@dreamamerica.com. If you forget that, you can also just go to our website and hit the general email and they'll forward it to me.
Awesome. And I will, if you have a moment, you can go through the chat. If not, I'll gather all those up for you.
Sure.
All right. Michael, I'm going to hand it over to you, and you can hand it over to GSH.
Absolutely. Thank you, Jeremy, very much. Thank you, Chris, for the presentation today. And thank you for everyone in the audience today for your time and attention. We brought together a world-class group of asset managers that are solving America's housing crisis and delivering great, exceptional returns.